Money.
I have some great news to share. I'm going to talk about my arena. I'm also going to talk about your CPA's arena. We're going to bring back the great news with mortgage insurance tax deduction coming back. Thanks to the Tax Relief and Healthcare Act of 2006 and the Mortgage Forgiveness Debt Relief Act of 2007, mortgage insurance premiums were tax deductible and treated the same as mortgage interest. We lost this benefit, but on December 18th, 2015, the president signed legislation that renews the tax deduction of mortgage insurance premiums for qualified borrowers through 2016. So the deduction is effective for purchase and refinance loans closed after December 31st, 2014. Mortgage insurance premiums paid accrued after December 31st of 2016 may qualify for a tax deductible for homeowners' federal tax returns. Now, lender mortgage insurance, also known as private mortgage insurance or PMI, in the U.S. is insurance payable to the lender or trustees for a pool of securities that may be required when taking out a mortgage loan. It is insurance to offset losses in case you, the consumer, is not able to repay the loan and the lender is not able to recover its cost after foreclosure and the sale of the mortgage property. So PMI is required on conventional loans with less than a 20% down payment. Borrowers with adjusted gross incomes below $100,000 may deduct 100% of the MI premiums. Now, I do want to disclose I'm not a licensed CPA. I'm a licensed mortgage professional. So you do want to consult with a professional. For borrowers with adjusted gross income from $100,000 and a penny to $110,000, deductions are phased out at 10% increments from each additional $1,000 of adjusted gross household income. Now, the homeownership deduction, it's huge. You can write off, as you most likely know, your interest on your mortgage, your property taxes, and now, just as I've mentioned, the PMI or the mortgage insurance as well. So let's take a look at how this looks. On a $400,000 loan, the deduction estimated, let's just say $25,000 for the year. If you were in a 25% tax bracket, this would be $6,250 less in income taxes you would pay as a homeowner with these deductions. Now, if you amend your W-4 with your employer and increase your withholdings, you can see the benefit in your income every month. You do want to consult with a licensed CPA to make sure that you're amending correctly and you're not having to owe money back at the end of the year. The idea is to break even. Now, the benefit is this is real cash and it's real money. It's just whether you choose to realize the benefit at the end of the year in less income taxes that you pay or upfront every month in your take-home income. Personally, myself, I want to see it up front, my take-home income, because I don't want the government collecting interest on my money. I want to be able to realize that benefit myself and do what I can with those that extra cash. Now, by realizing every month, what this is going to do for you as a home buyer is you're going to increase your buying power. So with my example, the deduction would be about $520 a month and equal to an increase of buying power of $95,000. So if I could tell you get an increase of $95,000 by amending your W-4 with your employer, make a huge difference in what you can receive in homeownership. Now, also, I want to talk about the renting versus homeownership. If we're looking at $2,200 mortgage payment after the tax deduction, the homeowner would net. It would be a net out to closer to about $1,700 a month if you're able to realize the deduction of homeownership. Again, consulting with a licensed CPA, depending on how you're filing your taxes. Now, this does not count the almost $600 towards principal for the first month. That's just an additional benefit. I like to call it a home savings account, money that you might have access to when you sell your property, as long as your property does not depreciate. Now, the equity potential and the security of the fixed payment is another benefit. So we've got a fixed mortgage payment for 30 years. Not counting taxes and insurance, your property taxes can go up. They'll actually go down if the property depreciates, or depreciates. It'll go up if the property appreciates. Also, insurance for your homeowner's insurance can adjust as well. Now, a lot of people don't really take this into consideration. So if you're renting and your rent payment only increased, let's just say with inflation estimated at 3%, a $1,700 rent payment the next year would increase to $1,750. Over 30 years, you'd be paying over $4,200 a month in rent with no end in sight. So it went from $1,700, 30 years later, $4,200, and you're going to continue to pay that with that increase in inflation. Versus if you have purchased a home, the payment would have remained the same. The mortgage payment would stay the same as long as you're a 30-year fixed rate mortgage. And at the end of the 30 years, you'd be mortgage free versus having to continue to pay that rent. So the risk of renting is the possibility of not being able to continue to afford to pay the rent payment with inflation. And again, the no end in sight with mortgage, being able to see that you've got a roof over your head, not having to pay for it outside of taxes and insurance. Now, another ownership of tax advantage for home ownership is when you sell your home up to $250,000 if you are single, or $500,000 if you're married. In profits are exempt from taxation. Now, any amount over those thresholds is taxed at capital gain rates. Historically, capital gain rates have been substantially less than tax rates on ordinary income. When you leave an apartment, no tax will be due, but you will also not have a profit, which I think it's kind of nice with this investment like any other asset class investment. You can really look at the appreciation of your home is just as an added benefit. As you can tell, I believe in home ownership, and there's a lot of benefit to getting into home ownership, and why I'm excited for a conversation that we'll have with our guest here today. Coming up next in the Money Hour, what's coming up for the new year with real estate? Well, I've got Matthew Gardner, Chief Economist with Windermere Services, right here on 1150 AM KK and W after this short break.